is a reasonable slate of UK company results due in the coming week, alongside a torrent of them in the USA and an interest rate decision from the European Central Bank. The ECB decision may give us some insight into policymakers' thinking in the wake of Liberation Day and President Trump's launch of new baseline and reciprocal tariffs on the 2nd of April. It's likely to be too early for companies to start quantifying the impact, although any guidance on changes in hiring or capital expenditure plans could be telling. And one UK firm, Mycelx Technologies, has already blamed the tariffs for a mild profit warning, as management cited the need to reprice contract tenders to reflect the extra cost of equipment sourced from America, because that kit features parts imported into the US. Anyway, companies which may, to varying degrees, be able to shed further light include Ashmore and Page Group on Monday the 14th, S&U on the 15th, although the focus there is likely to be the UK car financing market, Rio Tinto, Antofagasta, Hayes, Barrett, Redrow and WH Smith on the 16th, and Sainsbury and Dunelm on the 17th. But this week it may just be worth stepping back to look at the big picture and the issues which all investors must now confront, although we must accept that all of this could date pretty quickly if President Trump changes his mind about trade policy. Our starting point is that on the 2nd of April, the White House imposed baseline 10% tariffs on all trading partners with, in many cases, additional levies on imported goods from many countries. These duties added to the ones already imposed on imported cars, steel and aluminium, and some products, however, notably silicon chips and pharmaceuticals, were made exempt from the Trump tariffs. Stock and commodity markets had a tidy fit, especially once China responded with retaliatory tariffs of its own on the 4th of April. As I sit here, the FTSE 100 is down by around 10% in a week and by 13% from its February high. Meanwhile, America's S&P 500 and Nasdaq Composite are all down by more than a fifth from their peak, pretty much bear market territory. The so-called Fear Index, or VIX, which measures anticipated US stock market volatility, that shot up into the 40s, twice its long-term average and a level not seen since the outbreak of COVID-19 some 5 years ago, to outline just how nervous some investors are. Government bond yields have generally held firm, even gone down, and gold has held up too, as investors have sought a haven, although high-yield corporate or junk bonds, well, their yields have risen and their prices have fallen. Why? Well, in some, global stock markets during 23-24's good run had priced in cooler inflation, steady economic growth and lower interest rates. The tariffs and threat of a trade war threaten all three preconceptions. This is a particular issue for the US stock market, which investors had long since decided was great anyway. The S&P 500 was trading at record highs. The US equity market represented 2/3 of FTSE All World Index valuation, and that was a record high as well. And analysts were expecting mid-teens percentage earnings growth from the S&P 500 for this year and next, even after, on top of, the thumping post-COVID recovery. But at the S&P 500's peak at around 6,100, even that earnings growth put the index on a multiple of forward earnings that lay well above long-run averages. Again, that might be great if all goes well, but it leaves little downside protection if anything unexpected happens, as maybe it just has. US markets were bullish. There could hardly be a bigger contrast to 2011 when Occupy Wall Street was in its pomp. The S&P 500 stood at around 1,200 and no one cared after the great financial crisis. Wind forward to 2024, chat rooms were buzzing, meme stocks were surging, Roaring Kitty was meowing, margin debt was growing, and a crypto entrepreneur bought an artwork for more than $6 million and then ate it. It was a banana. All when the S&P 500 was 5 times higher. Spot the difference in sentiment and when stocks were maybe cheap and maybe when they were less so. Now sentiment swung again, so the issue is what could put a floor under the market? Well, there seem to be 3 strands of thought in the Republican Party about tariffs. One is that they're a tool to get better trade terms from other countries. This is probably the stock market's preferred scenario, as it means they may go away, or at least tariffs may not be as harsh as proposed, and that trade could start to flow again reasonably as before. Another scenario is that tariffs will bring in $600 billion a year in taxes and duties to America, helping it to fight the ballooning federal deficit and facilitate income tax cuts. That's maybe the US bond market's major hope. Another scenario is that this is indeed a long-term plan to boost American jobs and foreign direct investment to the benefit of growth. This seems to be President Trump's plan and underpins his comment about taking medicine and there being no long-term gain without short-term pain. Wall Street doesn't seem to like this pro-Main Street policy so much. Oil prices aren't keen either, and bonds are unsure because of the inflation risk. A series of trade deals to reduce tariffs may trigger a rally, and so could a sustained period of high VIX readings, since they normally mean panic, and panic can mean there are bargains to be had amid the selling. There's also the chance that a US slowdown forces the Federal Reserve to cut interest rates or even return to quantitative easing, whether inflation's sticky or not. But in the end, countries and companies will adapt because they always do. It just could take time. But valuation may also be a guide as well, so watch if Warren Buffett starts running down his record cash pile as his Berkshire Hathaway vehicle remains an expert value hunter. Hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.